Hi, this is Henry. Welcome to HC Strategies. In this video, I'm going to be talking about inefficiencies and also how to use them when they did not sustain. So when you're trying to anticipate to buy or sell from an inefficiency and then that key level does not hold, it becomes an inverted fair value gap. And I'm also going to show you examples of how to use an inefficiency and also when it becomes an inverted fair value gap, how you can use that as well. So I'm going to clean my chart. So firstly, we can see this inefficiency resting right here, and you can see how price used it as a resistance zone, tapped into it, dropped down, and tapped into it again the second time. And then you can also see this one right here. Price didn't get up to it, and then you can see this one. You can see how price tapped into it and will drop down. And right here, you can see this one resting right here. Now, this one did not eventually take price to the upside. So after price tapped into this inefficiency, you can see we had this impulse and then it dropped down to run this low. So when price taps an inefficiency and it fails to run the previous high, then that means that price could potentially run below it. If it runs below it, still maintain this key level, knowing that price will potentially come back into this key level to use it as a support or resistance zone. So if it's a buy, then you can anticipate, let's say for example, price had an inefficiency right here. So this is a down move and then we'll have an up move. And then there's an inefficiency resting right here. And then for some reason, price comes in and slams through that inefficiency. Now know that that inefficiency could actually also act as a resistance key level for price to reject off to continue to the downside if we're bearish. So that being said, now you can already see an example, an inverted fair value gap, and then this is an inefficiency, which is also known as a fair value gap. Now we're going to start from this overall high right here. You can see this inefficiency right here. And when price taps into an inefficiency, what you're anticipating to see is a break of structure. In this case, we were working with the 3-month time frame, right? Now, if we tap this inefficiency, we'll be anticipating to see a daily. Now, in order to make this very simple to understand, because I know that some of you are not really advanced traders, all you just have to do is you can count 3 time frames to the left. So let's say, for example, your inefficiency key level is the 3-month time frame. You count 3 time frames to the left from monthly, weekly, and daily. You can set your time frames as I have set mine right here. So once you see a daily, if price taps into this inefficiency and you see a daily break of structure, I outlined how to see structure, right? For example, this right here is structure. We're working with this high. We created a high, created a whole low, lower high. This is a higher low, and then we created this higher high, and then we created a higher low, and then we created a higher high. So this overall is showing us that price is trending to the upside. It has consistently been trending to the upside. And then to the downside, we want to see something like this. Then a lower high, a lower low, and then a lower high, and then a lower low. So this is a downtrend. Now, in this case, you can see that after price made this high, this all-time high right here, we dropped down, leaving an inefficiency. Now, we don't know whether the market is going to continue trending to the upside or not, but what we do is we wait to see a shift in market structure, right? Now, the moment price made this high right here and dropped down, leaving this inefficiency, all we're anticipating to see is price coming to this inefficiency. If it comes into this inefficiency and we see price drop down, breaking this previous low, which is now showing us a downtrend, what I just outlined right now, creating a lower high and a lower low. The moment we see this, all we're looking for is to go to the daily time frame and look for a daily break of structure right here. Now, I'm going to show you what I mean by that. If we go to the daily time frame, now we're on the daily time frame, right? Now, what we now do is we're trying to scale to the current price action. Now, you can see on the daily time frame that price is consistently creating a high right here, and then we created a low, and then a high, higher high, higher low, and then this higher high, a higher low, and then a higher high, and a higher low, and then a higher high, and then a higher low, and then we created a higher high, and then we dropped down, breaking structure. So right here is our break of structure, right? The moment we see this break of structure on the daily time frame, we outline this inefficiency resting right here. And this is where we can put our entry position. So if you have a 9 to 5 job, you can basically just put your entry position right here. Stop loss above this overall high. You can also add maybe 3 extra pips above it, and then just allow price to do its thing. So basically, this is a very swing trade, right? This is a swing trade that you can hold for months. If you're someone that you don't want to be spending hours on the charts, you just want to look at the market, probably a few times in the month, all you need to do is to wait for this kind of setups, and you can see how nicely it plays out. You can use this inefficiency that is right here. Try not to use this low, even though price will take that low, but it's best to use this inefficiency resting right here, and you can just make your profit. Or you can also want to, if you really want to hold it for a longer period, you can hold it to this inefficiency here. And this is the kind of trade that you can just take this trade and just basically a few trades in the year. If you're someone that you don't like being on trades that much, you just want something that is going to make you an extra income, and you can just do this. Very simple, very easy. And you can see how nicely price came down to your take profit position. So this is for people that want to do swing trading. You can use this concept for that, but it's basically the same concept whether you're doing swing trading, scalping, or intraday trading. With this concept, it works. Or even whether you're an investor, you're also going to see me outline how I use this same strategy in crypto investing. But first of all, I usually do my fundamental analysis, technical analysis, and quantitative analysis. Everything is going to be explained in this course. So in this one, you've seen how to outline the inefficiency, how I outlined it from a bigger time frame, from the 3 months, and I went down to look at the daily break of structure, and then I got into my entry, my stop loss, and prices smashed my take profit position, delivering a 1:9. So this kind of trade, if you were risking $200 in this trade, you'll probably make around 2,400 on this trade. Just one setup, that's all you need, and you can make that amount from there. So the next thing we're going to do is we're going to go back to the current price action, and I'm going to show you more examples as well. Now another example is this one right here. You can see this inefficiency. Once price taps into this inefficiency, you're still looking for the same thing. You count 1, 2, 3, and you go to your daily time frame. You want to see a daily time frame shift to market structure. So let's go back to 3 months one more time, so we can use the bar replay. So it's much easier for us to spot the area we're talking about. So right here is the area. Then we'll go to the daily time frame. Now on the daily time frame, you can see how price is consistently trending to the upside from this key level. We made the low, made the high, the low, and we made the high, and the low, and the high, and the low, and a high right here. And then we'll have a break of structure right here. You can see the break of structure this low. Now after that break of structure, all we're anticipating now is the inefficiency resting right here. That will be our entry position, and right here is the inefficiency right there. And you can see that price actually came into the inefficiency twice. You can see that. So right there, you can put your entry. If you have a 9 to 5 or you look after your kids, you can basically just place your entry position right there. Stop loss above this high, or probably 3 pips above this high, and then that's it. You just allow price to do its thing. So this is me going from the 3-month time frame for people that don't want to trade a lot of the times in the month. Probably you want to just be in the market a few times in the month. This is all you need. This is all you need. You can put your risk there. You can risk $136 right here, and then look at the take profit. You can see the take profit. You can be aiming for this lows right here. Right here, you can aim for this, which is a 1:9 risk to reward ratio. And let's see how that plays out. So you can see price has hit the take profit position. So if you were risking $136 on this, you would have made $1,222. So it's basically how you can easily make a few hundreds to a few $1,000s trading Forex without actively being a trader. You don't even need to stare at your chart. You just need to take out 10 minutes, analyze the market. And when it comes there, you see your shift to market structure, you put your entry position, and you move about your day. And then someday you just check your chart and you see you've made $1,200 without even raising a finger or doing anything else. So this is the second example, and we're going to go back to the 3-month time frame. So this is basically using this same concept to do swing trading. I'm also going to dive deeper how you can use it to do intraday trading for people that want to engage more in the marketplace. You can still see how I do that. So I've basically shown you structure, entry models, inefficiencies, and also understanding how to do premium and a discount position. So I'm going to end this here, and in the next video we're going to continue. So thank you for tuning in.